And anyway, gentlemen,
Yes.
enough about my plights and tribulations. This is a market that's holding up extremely well in the face of a lot of adversity right now. And what do we mean by adversity? We're seeing here what has been a brutal 2-day move in the bond market, which for someone who's been short ZB puts from a while ago, I mean, it's not great. The money is now gone, back to break even. But it's been a tremendous move over the past 2 days. And the question is whether or not we are finished. This has been a dramatic readjustment in part because there's been a dramatic readjustment in Fed rate cut odds. Last week on Wednesday, ahead of the Fed meeting, after those New York community bank earnings, the odds of a 25 basis point rate cut in March were close to 100%. They had a peak of 98% that day. Where we are today, much, much lower, about 18% right now. So yields have made this dramatic adjustment up across the curve, but the resiliency in the NASDAQ and the S&P can't be dismissed out of hand. They're both still loitering just a stone's throw away from all-time highs. Technical momentum is firm. Volatility really hasn't picked up all that significantly. And earnings have actually been doing pretty well here. I know that's something in the rearview mirror, but in terms of earnings, this is a market where we've now seen about a 1.5% earnings growth rate for the fourth quarter. It's the second consecutive quarter in which there's been positive earnings growth. A lot of it's on the back of better margins. Companies are laying some people off, but they're becoming more cost effective as they're doing so. They're able to get an incremental dollar out of everything they spend. And so stocks are being rewarded. A lot of it, though, is a concern that it's only in the Mag 7. And quite frankly, I wasn't a big believer in that. I didn't find a problem with the breadth story until something that happened on Friday this past week. Friday, we had a day where the S&P 500 was up more than 1% when we had more decliners than advancers. And that may seem like that's, not atypical, but in fact it is. It's only happened 14 times before in the S&P 500's history. And the forward returns to the market after an event like that aren't that great. It's basically a middling, shuffling, sideways type of market for the next month, 3 months, 6 months. And so while you have an okay seasonality backdrop for stocks generally in February, it's not a great month. It's modestly positive. You now have this overhang that the market kind of feels exhausted. So I guess my question to you gentlemen here today is, what do you care about more? Do you think that bonds are the problem for stocks that they were in 2022 and 2023 at points? Or is this just a market that wants higher, screaming higher, and there's no reason to stand in the freight train still trying to get too bared up here, even if gold's doing well, even if the dollar's doing well, even if bonds are getting slaughtered?
Okay, well, let's put a little definition around this. First of all, sure. Bonds, they're not getting slaughtered. Bonds got slaughtered in last year, the end of 2022, 2023. Bonds just pulled back to probably where they got a little ahead of themselves a couple of times. On the first rally up, and then they sold back off to the 119, 120 level, then back up to 125, and then back down to 120. I think bonds are just in this like 4, 5, 6 handle trading range, and they have gone. They're very emotional now.
This rate move is pretty significant.
I understand, but the bonds are very emotional now, and which means they tend not to grind one way or the other. They just have these kind of dramatic moves, but they are trading range bound for quite some time. And I agree with you on the all the Fed stuff. Obviously, the market just determines whatever the probabilities are.
Of course.
But I think the bonds, based on stock market's reaction to what's happened to the bonds, I think the bonds are just range bound, and the stock market doesn't think there's actually much risk in the bonds. The stock market thinks there is some risk in maybe not a rate cut immediately, but the stock market's not worried about. It really is not worried about bonds going back down to 112, 108, or that kind of stuff. Bonds have a pretty solid range here, and I think a lot of us have been, for me to get long bonds, I'm long bonds right now, just on the basis of mostly long notes, but I've been buying bonds and notes the last 2 days just because they got cheap on a short-term basis, just for a trade. And we're definitely range bound. The whole thing, everything we're doing right now is range bound. That's my bond take. I don't think it has that much impact on the stock market yet, because I think it's just in a range, and I think the market's treating it as such. I think that the real interesting story is the stock market, because the question is, have we reached a point where, I think I wrote about it this weekend and called it, essentially, it's a tug of war between gravity and greed. And there is there's reasonable expectations at some point for gravity to take over. It's just a question of how much greed is there. And I think when you look at these chip stocks, they're beyond the point of ridiculousness. The closest thing I can think of to NVIDIA right here is, Qualcomm in 1999. And that kind of, some of those kind of insane rallies, Sun Microsystems, Lucent, those stocks that never saw these prices again. I don't know what's going to send NVIDIA lower, but I think that sustaining, almost close to this $2 trillion market cap, it's going to be really tough for some of these chip stocks. I just don't. I think they've gotten way ahead of themselves to sustain these prices. For Microsoft to sustain this level, I mean, I don't see it. And when some of these buyers turn into sellers, I am really nervous. I think that SKU trading at 160 is not a fluke, and I think there is probably more. There's more outlier risk today than we've seen in a really long time. I don't think there's a tremendous amount of bear market risk. I don't think there's a tremendous amount of, like huge sell-off risk, but I do think there is outlier risk to the downside. And I do think that, that more so than we've seen for a long, long time. I don't see that in the bond market. That is the unique thing about the stock market, is the stock market, I think, has 2 and 3 standard deviation potential risk on a very short term, like flash type thing or something like that. In the bond market, I don't see it at all. I think you already saw that last year. But I don't see a prolonged grind to the downside. This is important today because for the first time, the Russell got strong, the NASDAQ turned south. I put that position on this morning, I took it off before we started this segment. But this is the first time we've seen a little bit of a reversal between, the small caps and the NASDAQ. And hopefully we start to see more with the S&Ps as well.
Well, if that were to happen, that'd be a very good thing for the market, right? Breadth widening out, participation increasing, people allocating away from the winners and into some of the laggards because there's so much optimism going around about the economy. And
I couldn't agree with you
Dylan
more.
Dylan relayed the message last week that when you guys were listening to the Powell press conference and Powell sounded optimistic, you were like, oh, no, that's not going to be good. But quite frankly, if the Fed chair is expressing optimism, I understand the sense of what you're saying, that like, oh, wow, he's going to be hawkish because he's so positive, so that's not going to be good for stocks. But if the Fed chair is this optimistic about the economy and that we don't really need these rate cuts just yet, they're coming, but what's the rush because everything's going so well? That should lead to a window in which small caps have the ability to outperform large caps, historically speaking. Not every time, but you would lean in that direction. What I found interesting about this whole 60 Minutes interview, everything that happened last week, all the Fed speakers that are due here in the coming days, is that the Fed seems to be afraid of its own shadow. The bond market's been giving it a pretty clear signal over the past few months that additional rate hikes aren't necessary and they can lower the Fed funds rate. And the way that the KRE, the regional banking ETF, is traded in the wake of that Fed funds meeting, it does seem like there's a little bit of a risk here that perhaps the market thinks the Fed is sleepwalking into a bit of a policy mistake. That aside, though, you brought up something very interesting with NVIDIA. It's not something that we were going to talk about today, but there's a story going around in the Financial Times that may interest people. It's rooted in some reporting that was actually done on Twitter X by this fin Twitter named Mr. Nobody several months ago, where he was looking through the NVIDIA balance sheets and noticing that they were investing in these companies, and then these companies were turning around and placing significant orders for NVIDIA GPUs, effectively channel stuffing, as it were. And so now that this has jumped from like the zeitgeist of the fringes of finance, which is FinTwit, right now into mainstream media, NVIDIA has a really interesting path ahead of it so far, is that it now has this negative sentiment that it needs to keep in check. So these earnings releases that are coming up, quite frankly, probably carry a little bit more weight now that some people are beginning to look at the numbers a little bit more closely. And that has been the bellwether for the broader market. As NVIDIA goes, basically, so has everything else. It substantiates and breathes life into the AI-driven narrative that's helping lift stocks here today. So NVIDIA right now, obviously no earnings this week. I mean, as far as I can tell, the most significant earnings reports today are Toyota and Amgen. And when you go through the end of the week, BABA tomorrow. BABA is, of course, an interesting test case after what's been going on in Chinese equities today. And I know, Tom, you've been selling.
I don't think there's any risk in the downside of Chinese equities. I think there's, if they open lower tomorrow on if BABA's bad earnings or something like that. I didn't know BABA had earnings tomorrow, Tony.
Yeah, 7th before the market opens. He's 100% correct.
But I love the Chinese. On a relative basis, China's super cheap here, and everybody's too bearish on it. It's in a good spot. But you bring up an interesting.
To that point. To that point, I saw something yesterday. There's an ADR of a Chinese company. I got to pull the ticker here. That's currently trading with a PE of 2 right now. Why is that so remarkable? Because if you were to take all of its liabilities out, its assets are worth more than the current market is valuing its share price is at. So there's such a negative sentiment in place right now about Chinese stocks. It's at an extreme level here.
Yeah.
I really don't like bottom fishing, as it were, but in terms of can things get worse?
Yeah.
There's been no good news about China recently, and now it looks like the Chinese government's getting ready to step in. They've been talking about verbal intervention a lot. There may actually be some legitimate stimulus around the corner. FXI up 4% today, last I checked.
Yeah, we had some coming in this morning. We sold it earlier. I think we might reload. Anyway, so you bring up an interesting thing on this NVIDIA thing. I want to go back to it for a sec because it brings back a funny story. So going back to 1999 for myself, when we were building Thinkorswim, we didn't know much about, we were just learning about building technology and things like that. And back then we needed to have servers. And so our dev team wanted to do everything in Java, which meant we basically had to be on Sun Microsystems. We needed their servers. Sun Microsystems had a plan back in 1999 that if you were a startup with no revenue, essentially no revenue, you had to have less than, I think, $1 million in revenue. And before we launched, we had 0 revenue, right? So if you had below $1 million in revenue and you were building a startup and you were going to use Sun Microsystems kind of as the tech foundation, so you're going to be on their servers, they would loan you. First, they'd discount you by like 50%, and then they would loan you the money to buy their servers.
They're locking you into their business.
Right.
It's not a bad business model. Nothing wrong with that.
So we had a bunch of different choices, servers, but Sun basically said, listen, and this is when their stock was over $100. Mm-hmm. It was 120 or something. And they said, and they were supposed to have great servers and everything else, whatever. No problem with the hardware. But I think we needed to buy, let's say, $400,000 worth of servers when we first started, for like a production system and also for like a test system. And so, $400,000 to a startup or $500,000 to a startup is a lot of money. So in 1999, so we were like, yeah, sure, we'll do this. So you're going to give us the servers for, let's say, $220,000 instead of $400,000. Because once you're in, you're in. There's nothing you can do.
Yeah, you can't change.
You can't change. And then on top of that,
life, and that's good.
You're going to put up the whole $220,000 for us. Charge us like, minuscule interest rate, whatever it is. And I'm like, how could we say no? So we did it. So we did it. Their sales at that time were off the charts because they were basically, and at the time we never thought about it. We're just like, oh, they're being really nice to us. But they were doing it to everybody. Yeah. Like we didn't care about other companies. Why would you care? All I know is we had $400,000 worth of Sun servers that I don't think we put up a dime for. And I'm like, how?
But you can't work without.
Which we needed to run the business. Sure. There's nothing. The hardware was great. Everything worked fine. To this day, we called them itchy and scratchy. There were two. It was a very. But we always said, how does Sun make any money on this? Like, what's their model? Their stock kept going up, and long story short, we eventually went in there and shorted their stock because we shorted it too early because we couldn't figure out how they made any money and blah, blah, blah. And then about 6 months later, their stock went to $0 or $4. It stayed around $4 until they basically, but at the time it was like 120. But anyway, same story as NVIDIA kind of right now. Hey, you buy our stuff, we'll put up the money, blah, 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 we'll lend you the money. I mean, I've watched this movie. All these stocks end up at, I'm not saying NVIDIA is going to 0. I'm just saying all these stocks end up at 0.
They do anything they can to keep sales going.
Yeah, Lucent did the same thing. Cisco used to do the same thing with their phone systems. Hey, if you put in our phone system, we will discount it by, 40% and we'll lend you the money. And we're like, we don't really want a Cisco phone system, but for nothing, we'll take it. And then, next thing you know, you have a crappy Cisco phone system. Now the good thing is you don't need phone systems anymore.
Right.
Oh, I don't know about that. I was just complaining about this the other day. There's something I miss about because I grew up, in houses that still had landlines, and there's a rotary phone at one point. Like now when I hang up my iPhone, like I don't get that satisfaction of like the clang. Right?
The greatest thing.
I want an app on my phone, so when I press the end button on my iPhone, I hear like the slam of the rotary phone.
The greatest thing, Chris, go to your kids and give them a rotary phone and say,
See how they make it work.
yeah, call my house. Here's my number. If they're old enough to call my house, here's the number. See what they do with it. It's really funny. The TikTok videos on that are great. Parents
call my house. Do you think that we have a landline in 2024?
Call my number, whatever it is. It's just see if they can figure out how to use it. It's great.
I don't know about that, but she knows how to turn on the TV and get to Disney Plus at this point. It's like, how is Rapunzel and Tangled back on again? It's like, she figured it out.
That's all
Great.
she needs.
Oh, more Rapunzel.
There's a TV show, there's a movie, there's a Disney Junior movie. There's 3 seasons of 23 episodes. I know so much about the lore of Rapunzel now. I'm being a good dad, I think.
That's good stuff. All right, what else you got? We got a few minutes left. What else?
Just in terms of the rest of this week, I mean, we said before, this is a very thin macroeconomic calendar this week. We've kind of we spent our shot last week when we had the FOMC and NFP, but we do have CPI coming around the corner next week. Part of the reason why I think it's prudent here when you look at bonds, and Tom, I know that you don't care about the fundamentals, but I'm going to tell a story here. CPI next week is tracking to come in at 2.1% for the PCE, the Fed's preferred gauge. The Fed has been telling us, in 2 weeks for PCE, the headline CPI next week is supposed to come in at 2.9%.
Okay.
The Fed's been telling us for months that they're going to cut rates before we get to 2% on inflation. The Fed doesn't care about headline CPI. They care about the personal consumption expenditure index. 2.1% is as close as you can get to 2 without getting to 2. And so for the market to be all wound up that a March cut, a May cut is potentially done, the path of inflation doesn't necessarily stipulate that's correct. And there's, I think, a reason why bonds have been doing what they're doing the past week. The last 2 days, obviously a little wonky in the wake of the non-farm payrolls report, which to me wasn't even that good of one. But the CPI coming up around the corner next week is going to be a seminal moment where people get back and check and say, wait a second, the Fed is actually wrong here. They should be cutting in March. Do I have any reason or rhyme to think that I know more than the rest of the market? No, of course not. But down here, as long as we're hovering right around 119, 120 in ZB, we have that swing low from a few weeks back to work against. Volatility is not that high, but the IVR is now back above 20. This is one of those, if you see bond volatility rise in 2024, fade it. That's what we said coming into this year. At least that's what I said. And I think this is still a decent opportunity right now for traders in the market. Of course, if you're looking for bigger IVs, oil is still the place to look. It may be trapped in a range between 68 and 80, but selling puts, putting on an iron condor, they continue to work. They've been working for several weeks now. I know it's a one-trick pony, Tom, but if it's not broken, don't fix it. Keep hitting the same strategy until the market tells you that you need to adjust to something else.
Yeah, I mean, you're right. And like I'm short crude oil /CL strangles. And today, even with short delta in there, they've come in actually pretty nicely. Most of our commodity positions, I'm just looking down across the board today. Yeah, most of them are okay. And by the way, we did nibble this morning. This is right up your alley, but we did nibble this morning on gold silver, that pair. Mm-hmm. It's up to, I think the ratio's a little over 91.5. So, which is the highest it's been buying silver, selling gold.
I have an iron condor on right now in silver, in gold. It's been chopping around for several weeks. We saw this attempted breakout, and so I'm kind of just trading it sideways for the foreseeable future. I'm at 18 days to expiration though, so it is, or 19 days, so it's time for me to roll that position. Yeah. I'm going to continue to roll it, right? Again, if the range is working and holding, continue to trade the range until it stops.
Yep, and then for anybody that hasn't seen our videos on this, if you have a futures option position, we treat it the exact same way as we do listed options, meaning that we roll at 21 DTE. Sometimes it's not as clean, the roll process not as clean on the Tasty platform. But if you're rolling for credits, you can roll forward. If not, you close one and do the other. But we use the same mechanics. So at 21 days, we roll forward. So if you're down to 18, it could be 18, it could be 16, it could be 24, but whatever it is, that's our roll window.
Absolutely,
All right, Mr.
absolutely. So that's a plan for today. One last thing, though, I want to give a quick plug to Dr. J. His new options crash course premiered on Sunday after first call. It's available on the website. It's available on YouTube. Be sure to check it out. Learn more about options, particularly the risks involving them, and why that may not be what you hear.
Awesome.
When you say Dr. J, he was like really one of my childhood idols. I cannot put Dr. Jim in that class. Okay, it's painful for me. We have to go with Dr. Jim.
Okay, you're the boss.
Quick 90
Dr. J is too close. You know, I love Dr. J.
Finger roll.
Finger roll.
We'll take a quick 90-second break. We'll come back. We got more Tasty Live after this with Market Measure next. This is Tasty Live.